So the big question is this: how do investors like us who trade options and manage our own money generate income regardless of where the stock market goes, and do it all in a way that lets us make time for the people and things we love, and yet still build wealth and remain profitable? That's the question, and this podcast will give you the answer. I'm your host, Kirk Duplessis, and you're listening to the Daily Call from Option Alpha. Hey everyone, this is Kirk here again from Option Alpha, and welcome back to the Daily Call. Today we're going to answer the question, can you generate an instant profit buying in-the-money call options? So many new traders and many experienced traders as well wrongly assume that you can generate an instant profit buying in-the-money call options. The reason that they assume this is they attribute most of the value to these call options as just the difference between the strike price or the in-the-money strike price and the market price of the stock. And they think that you could buy the call option and resell the call option back to the market for a quick profit, or buy the call option, exercise your call option, which would purchase stock at the strike price, and then resell the stock back to the market at the current underlying stock price, conceivably much higher than where you bought the in-the-money call option. But in either of these cases, what they fail to recognize is the premium and the extrinsic value of the option contract. So for example, if we have a stock that's trading at $100, we might assume that we could buy the 95 call option, which is in the money by $5, and make a quick instant profit exercising our call option at 95. So effectively buying stock at $95 and selling it back to the market at the $100 price that it's currently trading at. But the assumption here would be wrong because the value of that option contract might be $5.10. So the value of the option contract at $5.10 accounts for the intrinsic value, the value of exercising the contract right now, which is $5. So that's the $5 difference between the stock price and the strike price. And then it has a little bit of extrinsic value baked in, which is about 10 cents or so that potentially there's some time value left in the contracts, there's some volatility value left in the contracts. And so therefore you could not immediately generate an instant profit by buying these in the money call options. Now this extrinsic value could be very small, like our example right now, if you're close to expiration, or it could be very large. Sometimes the extrinsic value could be double what the intrinsic value or more of the contracts are. So again, it's a wrong assumption to assume that there's a free opportunity or an arbitrage opportunity just buying in the money call options. So hopefully we've clearly explained it. As always, if you guys have any questions, let me know. And until next time, happy trading. Thanks for joining us on the Daily Call. Be sure to subscribe right now for more daily options trading ideas, strategies, and tactics to help you learn how to place smarter, more profitable trades. And if you like what we're doing, don't forget to give us a rating and a review so we can continue to bring you the best daily content possible. We'll see you again tomorrow, right here on the Daily Call from OptionAlpha.com.